Good Sunday morning, everyone. Hope you had a great Thanksgiving holiday, and if you're traveling, you're getting home safely. Unfortunately, the Cowboys lost and the market lost on Friday. So I could think of other scenarios to end my Thanksgiving holiday with. The big down market on Friday and the Cowboys loss certainly were not among them, but what can you do? That's life. I hope your holiday was great and you were surrounded by people who loved you and you enjoyed their company and you had great food and were thankful and had nice adult libations. Let's see. So we're gonna do a quick video well, I say quick, but you know me, sometimes quick gets to be dragged out a little bit. So one, most importantly, thank you for watching. I greatly appreciate it. If you like what you see, please give it a thumbs up on YouTube. I am going to, let's talk about today. We'll do a little bit about the market, maybe a sneak peek into what I'm thinking for 2022. And we'll talk about the Fed a little bit, and then a follow-up from my last video. I forgot what I titled it. I'm sure it was kind of obnoxious. I think it was something like the idiotic imbecilic investor. Okay, so let's dive in. If you're looking to schedule a meeting, I have apologized via email. I've apologized on the phone. November and December's calendar are unusually crowded. Clients I will always try to squeeze you in. If the time is not available on my calendar, you could certainly email me or call the office, and I promise you I will get you in. Promise. Whether it's earlier morning or evening or weekends, but you have my word. I promise you I will get you in. I'm just doing my best. As some of you may have read, I took some time and headed out west. Can't remember now. The weeks get so screwed up because of the holiday, but I was out west playing golf, which is the first time I've done that in a long time. But you can read about it on the blog if you care. So let's move on. I'm scheduling for clients. You'll probably get notified in the next 2 weeks. We're going to do a bourbon, vodka, tequila tasting in, I think, January, and then a wine tasting with Kerr Cellars sometime in the spring. So I'm going to try to get that going. I want to get ahead of the game for a change rather than run around and put the event together last minute. So you should get notified about that shortly. Any other housekeeping announcements? I don't think so. So let's jump in. Let's talk about the market on Friday first. Friday was a holiday shortened day. Market closed at 1 p.m. You know, like in the summer when they say, quote unquote, everybody was in the Hamptons, so no one was working. That's all nonsense. We know that computerized trading accounts for roughly 70 to 75% of all volume today. The computers don't sleep. They trade when the markets are open. So are we shocked about the magnitude of the move? Given that the markets were thin, meaning there were less participants, but people were certainly there working, and you had the news of the new COVID variant out of Europe. So it's no surprise that what normally is a seasonally strong day, Wednesday and Friday of the Thanksgiving week, are normally seasonally strong. I opined in, I forgot what blog day it was, that perhaps the market may have borrowed some of its strength for Wednesday and Friday on Tuesday. Again, I'll say this, I did not see that magnitude of a decline coming Friday. Did I think we could have declined? Sure, because the market wasn't trading great. I thought I didn't have high conviction that the final low for the year was in and we were going to take off, but I didn't see a magnitude of a 2% decline coming. With that said, I was really surprised at how many people, what I thought was an exaggeration, not of the magnitude of the decline, as I'm looking at my screen. Yeah. So I see, the S&P down 2.3 and NASDAQ down 2.25, et cetera. The mids and smalls are down 3%. people now with the law of large numbers, when they see, the Dow down 1,000 points at any time, they go, oh my gosh, the market's crashing. A 2% decline in the stock market used to happen every month. I think the average was about 10 to 11 times per year, which is roughly once a month. Since the Fed has had a much heavier hand in the markets, the Fed's heavy hand has compressed, has pushed down volatility. And that's one reason why you haven't seen your normal, forget about 1,000 points in the Dow. Let's ignore the points, because as the market was at 36,000, the numbers just get bigger. But a 2% decline is a normal. If you ran a distribution of returns on a daily basis, it would fall well within the realm of normalcy. But I was surprised at how many people took Friday's decline as the sign of a bear market, or another 20 to 30% down. This is not February of 2020. And some people think, and I was just emailing with my rabbi about recency, where people take most recent things, events, occurrences, and assign a lot of extra weight because they just happened. For instance, after 9/11, anytime there was an issue in the sky, we always thought about terrorism. We assigned blame, and the markets declined as such. And I think right now it's the recency of COVID, March of 2020. We have a new variant. And if you look at some of the charts and some of the scientists and the numbers, forget about the opinions. This one looks more vertical than the previous iterations. But it says nothing about how deadly or how hurtful this new strain is, just that it was spreading at a faster pace. So I think people, because they remember March 2020, we're not going to have the United States of America's economy locked down again. And I said this, I think it was in April or May. They're never going to lock down our economy again like they did in March of 2020. I think we learned a lot of lessons. We didn't have, therapeutics. We didn't have PPE. We didn't have a lot of things back then. This is not the same as it was in March of 2020. Let's put that aside. Now, markets did decline significantly on Friday. We had a big, ugly, bad down day and on a holiday shortened day. Should we look into it and look for more things as this is the beginning of the end? My thinking, I don't think so. I don't think the bull market is over. Certainly Friday did a little bit of damage, but again, as I'll pull up a chart in a minute, it was one down day, so close to an all-time high. It was just a law of large numbers on a holiday shortened day that I think made people feel a little worse. Put my cheaters on. Stand by and put my cheaters on. So, and I'm going to share my screen. Give me 1 second to share my screen, and we will look. So there we go. Share screen. So let's look at the S&P 500, and we certainly don't need a year's worth of data. So here are my comments. Number one, back in early May, on the big down day, I said, I did not have high conviction that this was the bottom. I wanted to wait and see. And then right in here, I said, I feel pretty good that we've seen the low. Okay. Back in September, this is the big shock and awe decline. I definitely did not think this was the low. I thought it would be one more low to follow. It did. It wasn't until I think in here where I felt much better that a low had been reached. I'll say the same thing today. Do I think Friday was the bottom? I don't think so. I don't think it was the low. I think we will make a lower low, shortly, I'll say, without pinning myself. But, you look at something like where the old highs were. So somewhere between, 4,500 and, 4,600, at the 100 points, I'll give myself a little bit of cushion. I think the S&P is going to form a low in here. So not the end of the world. Before Friday, right? We were what? We were within a day of an all-time high. One decline, all of a sudden people are thinking like, this is March of 2020 again. So again, 4,600 or 4,500, somewhere in here, I think we'll form a low and we'll have a rally. That rally is going to be super important to tell us if we're going through, 4,750 on the way to 5,000, or we're just going to have a failing rally below new highs and then roll much deeper. I do not have a strong opinion just yet. I want to see what happens if and when we have this next rally, which I think is coming. I will write on the blog for tomorrow to pull up some charts that I didn't have time to prepare. Probably just because I'm too lazy right now. So that was the S&P. Again, not the end of the world. I would not assign too much blame to one down day. We've had lots of days like this. Well, not lots, but certainly, this was one of them. Oops. That was one of them. Didn't really lead to much. That was one of them. That was one of them. So during right near the lows, at least in September and October, we had these kind of down days. I'm not going crazy yet. Although clearly we lost money Friday. So it wasn't like I came into, the Thanksgiving holiday thinking, yeah, we're going to be down 2%. Probably should raise some cash or put some hedges on. I didn't. We still own, what do we own? NASDAQ and large cap growth and some small cap value. And in the sector side, what the heck do we own? We own banks and financials and industrials and materials and energy and internet and biotech, kind of a mishmash of a bunch of different sectors. We'll see what happens this week. But certainly a 2% one-day decline is far from the end of the world. And let's see what else. So someone's going to ask me, I'll answer the question before you email. Well, where are the opportunities now? I think we could be setting up for an opportunity in gold. Is it short-term, long-term? I don't know, but we've had a pretty good decline in gold. And as many of you know, I like to trade the GDX. So I think we are coming close to some buying point between 35.50 and 30, I'm sorry, not 35.50, 30 spot 50 to 32. Somewhere in here, I think the gold stocks will find a bid and mount a rally. That's the opportunity I see unfolding perhaps this week. That's on my radar screen. All right, let me stop sharing, and now I'm back. I'm gonna pull up one more thing. Then, okay, there we go with that. And so my last couple of topics will be, let's see. Oh, a sneak peek at 2021, which we're getting to the end of November. And folks, I'm just giving you what I think and feel and are looking at right now. That may change when I write my 2022 fearless forecast. But right now, my thinking is the bond market does a whole lot better next year. I think bonds rally, which means long-term interest rates go down. That's number one. Bonds rally, long-term rates go down. At the same time, the Fed probably raises short-term interest rates. So the yield curve is going to compress. That's one. I don't think next year is going to be a rip-roaring year for stocks. I think we will be lucky to eke out a gain next year. Lucky to get a gain. I think best case next year right now, I'm thinking is low to mid single digits. And you already know this because I've pounded the table on it since the end of October. I feel very strongly, high conviction that inflation right now between end of October and the end of March, inflation's peaking for the cycle. I feel very strongly about that. We are seeing the peak in inflation, and I think the whole supply chain challenges will go away sometime in the first quarter of 2022. So And those, again, that's like me banging on the table. That's high conviction. I feel strongly about that. That's an early look at next year. What else can I tell you? Oh, the Fed. So Biden, it took a long time for President Biden to renominate Jay Powell to lead the Fed. If he had changed to Lael Brainerd, it would have been the latest change in the, as close to a renomination in history. Usually, if they're going to change, they do it early on to give Congress the time to conduct their hearings and embarrass the public and attack the candidate, et cetera, et cetera. My thinking, I met a guy in Chicago a couple months ago, and he opened my eyes to a really interesting thought process, and that was they were holding off on the Fed to see what happened with the various infrastructure, traditional infrastructure, and I think they call it the human capital infrastructure. And if need be, Biden was going to use the Fed chair to appease the progressive wing of the Democrat Party. So he would not renominate Jay Powell, bring up Lael Brainerd, and then that would be food for the progressives in return for voting for something less on the infrastructure side. That didn't work out. So now we've got Powell back. There'll be hearings coming up, and we know Warren is going to oppose it, and maybe Sanders and maybe Brown from Ohio. We'll see what happens. But Powell, I think once he gets reappointed, we're renominated, reappointed, confirmed. There we go. Three times the charm. Once he gets confirmed, then I think he's really going to push to attack inflation. And I believe he did not want to do it so far because the progressive wing of the Democrat Party, who could have controlled his confirmation, would not have gone for a hawkish Fed chair. So we're going to get Powell back. Brainerd is going to be the vice chair. For those who don't know Lael Brainerd, she is very dovish and very aggressive on bank regulation, which lines up with Liz Warren. As we know, Warren does not want Powell because she thinks he's soft on bank regulation. Form your own opinions. But the markets were happy that Powell got appointed. Less uncertainty to deal with. He's the known quantity. So that's the Fed. And finally, last time I showed you the chart of the naked wines that I saw that TV interview and the stock. So I'm going to show that one more time as the heat is coming on in my office. So here, all the way on the left side of the chart where the spike was where I did the video, where the stock went from roughly $9 to $25 in like 15 minutes. As you know, it was absurd. I said that. But since then, let's get rid of that. So it goes from 25, and then a couple weeks ago, the stock is down to under 8, 25 to under 8. I mean, I'm sure some knuckleheads still held on, the guys and people who bid the stock all the way up. Now the stock is, 840, and here's a daily. You can look at it here. If you really want to see what never to do in the markets, this is the epitome. You watch a hedge fund guy on TV who already owned 10% of the stock. He pounded, that was his best idea at a hedge fund conference. Well, duh, it's his own book. What's he going to say? I don't like it. Absolute knucklehead, moron, greedy people run it from $9 to $25 in minutes. And then, of course, the market pulls the rug, like Linus and Charlie Brown. And now the stock goes back to under 8, and it's settling in at 840. That's why I think you don't follow the herd. Don't get emotional or overly emotional. And stuff like this almost, not all the time, but almost always settles back, settles out. Water finds its own levels. There's a level of equilibrium. So now you're at 840. If you love the stock on the hedge fund manager's thesis back in 10 to 25, it's now 840. Now at least you could deal without the pressure and the hype and all the nonsense. Now you can say, okay, Now maybe I'll buy 100 shares, 1,000, whatever you buy. But to do one of these, to me, is just simply the most idiotically absurd, imbecilic reason and behavior. You just don't do this. This is how people lose fortunes. All right. So that was a follow-up from that. Again, if you have any questions, comments, things you want to bring up, you can certainly email me, Paul at Invest for Tomorrow. You can call the office, as always, and talk with Renee, who will pass you on to me. And we can go from there. So I thank you. So again, hope you had a great Thanksgiving, a peaceful one, certainly a meaningful one. I hope you stay safe and healthy, and this variant is overblown, and we're not even talking about it come January. That'd be the best of all worlds. But from here, let's see, give me a thumbs up if you like the video. And if you are a blogger, I will be writing on the blog tomorrow morning. I'll publish some charts about what I saw in Friday's action that may be interesting and relevant. So again, I really appreciate you watching. Thanks so much for your time. Stay safe, stay healthy, stay happy. Talk with you soon. Bye-bye.